Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everyone, and welcome back to another episode of Blind Spots. In this episode, we are going to be talking all about the Modern Wealth Playbook. We are going to be going over the risks, the upsides, and how digital currency options might just change the way that you think about wealth.
So when Erin says the Modern Wealth Playbook, she means incorporating potentially digital assets into your balance sheet. And before we get started, we are going to talk about what the old playbook looked like, which I think still has a lot of merit, should be included in the modern playbook. We're just going to be adding certain things. So first off, I'm going to be talking about digital assets, and I'm going to be attempting to speak in simple terms that everyone can understand. It's a complex neighborhood. There's a lot of jargon, and if you think there's a lot of jargon in traditional finance, then digital assets is on steroids. So there's going to be a few words that keep coming up, and I just want to define those. So digital assets, cryptocurrency, you can think of those interchangeably. Okay, so that's like fixed income and bonds, digital assets and crypto, same thing basically for the purposes of today. And when I refer to digital assets and cryptocurrency for this podcast, you can throw in Bitcoin in there too. So those three things, Bitcoin, crypto, and digital assets, can be used interchangeably today. Decentralized is going to be thrown out there. And what that means is it's not controlled by any government, any entity, any corporation. Decentralized is, you can think of it in terms of crypto as a network that's open and can't be changed by anybody. So it's basically a public network. And centralized would be the opposite. So when you think about centralized, think about a government, a big bank, a corporation. That's centralized. The last definition is fiat currency, which is kind of fun to say, kind of sounds funny, but all fiat means is paper money, the dollar, the euro, the yen, government-backed paper money, okay? And I also want to be clear, I'm not advocating for digital assets. This is designed to educate, to have a conversation. It might be appropriate for some, not appropriate for everybody. This is a very risky asset class. There's large swings. It's relatively new. So Bitcoin's been around since 2009. In the grand scheme of things, that's still a new asset class. It's unproven. But I think the flip side of that is, I think there's a lot of investors and advisors that have been doing things a certain way for 40 plus years, let's say. They should be open to digital assets, because digital assets are not going anywhere. And for those that dismiss it, that say it's a Ponzi, it's a scam, it's used for illicit activities, I think that's really lazy. That might have held some merit back in 2010. It doesn't hold any water now. And the best analogy that I could use is my attitude towards Tesla, right? Like, I've never been a Tesla fan. While I can certainly appreciate what they've done as a business, there was just some things within the business and the way they operated that I thought that company was uninvestable with my personal money. Okay. Fast forward to today and looking at Tesla's journey, I can confidently say that I've been wrong. Tesla bulls, Tesla believers, Tesla investors have been handsomely rewarded. Okay. What I'm seeing and why I bring this up, there's a lot of Bitcoin and digital asset haters and naysayers out there that continue to dismiss the asset class. And my question to them is, at what point do you start to open your mind and appreciate the run and the returns and the progress that the digital asset space has made? Some of the smartest people on planet Earth are getting involved in digital assets. And I'm not saying, again, that it's for you or that you need to FOMO into this. But if I was a professional investor, I would get curious. I would start to ask questions. So at what point do these people stop and say, okay, hey, I've been wrong. There's something going on here. I'm going to open my mind and at least learn more about it and educate myself. So that's the parallel. You might ask, why are we doing this podcast? The reason why we are doing this podcast is because this is my personal opinion. This is not Pure Portfolio's opinion. I think digital assets are going to be a staple of institutional and retail investment portfolios within the next 3 to 5 years.
It's a big statement to make.
I think it's less of a big statement. I mean, if I said that 10 years ago or 5 years ago, I might sound like I'm crazy. But I think when you look at the sheer size of the digital asset space, I mean, Bitcoin is almost a $1 trillion market cap project. I mean, think about that. That would be like the size of Meta or Facebook before it had its plunge. Bitcoin, if it was a company, would be one of the biggest companies on planet Earth. And the rest of the crypto market, so Ethereum and all the other blockchains and even the crappy altcoins, make up another $1 trillion. So crypto, up until the recent sell-off, was a $2 trillion asset class. And yes, I said asset class. I don't think that can be ignored.
Yeah, well, when you put it that way, it is, like you said, hard to ignore. So let's talk about the old playbook. Talked about how there's this new age investor. Just give us a quick rundown of what the traditional wealth building method is, because this is what most people who are listening are going to be familiar with.
Yeah, and I don't necessarily love the term old playbook because I think it still has merit. And so the traditional wealth building method or process, right? You work for 30 plus years, you might bounce around jobs, but you're saving, investing in your 401k. Maybe you own a house and you're building up equity as you make payments over time, but you're consistently saving in these traditional avenues, your 401k, your IRAs. Maybe you have a Roth, maybe you have a joint taxable account with your spouse if you're married, and you're really autopiloting your savings, if that's a word, on a monthly basis. You're compounding it over time. You're building wealth slowly. And again, this approach is still a great cornerstone piece to have. It's your core wealth piece, as I would call it. So maybe instead of old playbook, your core wealth piece.
Okay, so we've got the core wealth piece. Now, let's talk a little bit about how the internet has changed the way that we build wealth. What additions or changes are we starting to see as part of that core piece to build wealth? What does that new way look like?
Well, it's a great time to be alive. I mean, the internet is an equalizer. Like, to me, it's fascinating. Someone could wake up at noon, sitting in their sweatpants, eating a hot dog, and could make money online, like sitting in their underwear, sweatpants, underwear. I don't know. But by clicking buttons on the internet, someone could make money. And they don't even have to be awake. Like, you could set up software as a service. You could code. You could set up an e-commerce site and literally make money while you sleep. It's a great time to be alive. So piggybacking on the traditional core wealth piece, you can add side hustles. You could start an online business, like I just mentioned. You can work from anywhere. And kind of the biggest connector or biggest opportunity of them all, in my opinion, is digital assets, which I often explain to people. Digital assets are really just internet money. And when you think about internet money, it's not unlike what we're already doing. Like when you go in your 401k and buy a stock, or when you go in your IRA and buy a stock, you're not getting the paper receipt. You're not getting the paper stock certificate. It's a ledger balance on Schwab or Fidelity or whatever portal that you use, and it's programmable internet money. It's a ledger entry on some digital spreadsheet. That's all it is. So, when people talk about digital dollars and stable coins and digital assets, it's in the same neighborhood that you're already operating. It's just under a slightly different umbrella.
Okay, so you kind of gave us a foundation of understanding for, what these basic terms mean. So maybe for the person who says, great, those definitions are nice, but I need a parallel to be able to understand how investing in digital assets meets the traditional way of investing.
Okay, so there are some parallels, but let's start with what was the original premise of Bitcoin? Like what was the original intention or problem Bitcoin was trying to solve? I think that's a good place to start. Okay. So the original premise of Bitcoin was to offer a seamless, frictionless way for people to send digital money, Bitcoin, across borders without an institution interfering. So if Erin lived in Egypt and I lived in Florida, I could send Erin $1,000 in Bitcoin with a couple clicks of a button for minuscule fees, right? So maybe 50 cents, okay? If I was to do that same transaction in a centralized traditional umbrella, that would cost maybe $200 or 20% of the $1,000 I'm trying to send Erin. And think about your relationship with your bank. And I don't want to name a bank. I used to work at a big bank. I don't want to get in trouble, but we all can appreciate the frustrations of working with a big Wall Street bank. They fee you for using a checking account. They fee you for sending a wire. They hold your funds. They have terrible service. They're the most fine companies on planet Earth. It's safe to say that digital assets exist because the current model doesn't work for any of us, okay? I think we're starting to see the utility for some of these projects really emerge. And what I mean by that is rather than day trading Bitcoin or other digital assets and trying to make money, people are starting to use them for their original utility, for their original use case. And I think that's a very exciting thing. And I think the convergence of multiple factors, including what's going on in Russia and Ukraine and what went on in Canada and what goes on in third world countries where people don't have access to banks or internet or phone. I think all of these things have converged to really provide a tailwind to digital assets. Like the story is starting to happen in real time in front of our eyes.
Yeah, since you've brought up this kind of replacing the wire, it also made me think of this also having the ability to replace like Western Union. That's how people send money to foreign countries back and forth a lot. So it's more than an investment to make money, but there's daily use even today. That's pretty interesting.
Yeah, and we're still in the early innings. So, for those that think they're late to this or time has passed, I mean, we're still in the infancy stages of digital assets, utility, peer-to-peer payment networks, security. So on the regulatory side, I think digital assets scare a lot of people because it still is the Wild West. And that's true. And that's probably the biggest gap in digital assets is it's just, there's scammers, there's frauds, there's, it can be complex. And we'll talk about some of the pros and cons too. But I think it's just not, it's a high barrier to entry for the average person. And I think they're working on solving that, but there's still much work to be done.
Yeah, so there's a lot of ways to view digital assets, I feel. And I think for a lot of people, they see it as an investment, a way to make money over time. But where do you see the majority of use coming? Is it the day-to-day use and one day being another form of currency that many people are starting to adopt? Or do you see it as a long-term investment? Where does it fit in?
I think it's all of the above. And let me use an example. So with the Russia-Ukraine war, the U.S. and other developed countries place sanctions upon Russia, right? Designed to trigger economic stress for that country, which triggers social unrest, which could lead to a leadership change in that country. But I can tell you, and I'm not a geopolitical expert, but usually what happens when you weaponize a currency, in this case, weaponizing the dollar and the euro, the billionaires, the oligarchs, the Vladimir Putins of the world aren't the people that suffer. It's the citizens. So what really bothers me, and I think is again, a tailwind to digital assets, 150 million innocent Russians are frozen out of their bank account. And if they do have access, they're seeing the value of their life savings in the ruble crater. I mean, it's come back a little bit. It's come back a decent amount, but crater by 70% or 80% at the start of the war. If they could access their funds, they could only take out a certain amount. And I think that is atrocious. Like that's not fair for anybody. Imagine if you woke up one day, your whole life's work was sitting in a US bank and you couldn't access it. and the value of the dollar plunged by 80%, and you had to feed your family or you had to pay your bills. I mean, that's an absolute nightmare. And I think it throws into question the system in which we're operating, which brings back my earlier comments of having a decentralized payment network where a government, where a dictator, a corporation cannot unilaterally block your access to your money. Okay, the same thing happened in Canada with the shipping protests going on due to the COVID restrictions in Canada. The Canadian government went in and unilaterally shut down people's bank accounts. I mean, that's just not okay at any level. And I think when bad things like that happen, it fuels the digital asset, the Bitcoin narrative, because again, no one can mess with that network. It's a decentralized network.
Yeah. So one of the upsides that you've discussed just now is the decentralization. But as of today, I can't walk into Fred Meyer or pay for my gas using Bitcoin. So what good does it serve me to own digital assets in 2022?
Oh, Erin, but you can. So there is, so this is emerging, and this is what's exciting, is there's now credit cards, like digital asset credit cards, where you can use fiat paper currency with them, or you could have Bitcoin and spend money with your digital asset credit card against Bitcoin. And you can make payments in Bitcoin, you can pay your credit card bill in Bitcoin, and it's very flexible. So this is out there right now. And there's like 4 or 5 companies that have these credit cards. I currently do not have one. I'll probably get one someday. Also,
so how's the conversion on that? If I go and I see an apple for $1, when I go to check out, or when I get in line to check out, because you know those lines at Freddy's at 4 o'clock on a Friday are not friendly. When I get in line versus when I get there, my apple is not going to just cost $1 equivalent of USD. So how does that work with the credit card?
That's the risk, is your Bitcoin can be rather schizophrenic. It can move a lot. You know, we've seen that in the last week or so. But the value of Bitcoin is always changing, and you're paying for stuff. So that's kind of the downside for using digital assets, because the markets never close. They're open 24/7. And by the time you get out of your car to check out at the Fred Meyer's, Bitcoin could be up 10%, it could be down 10%. There's something called a stable coin, which you can utilize if you want to hold a stable asset on a decentralized exchange or network that is pegged to the dollar. So you could convert some of your Bitcoin to stable coins, which should track the dollar, which won't move a whole lot, to pay for your apples. That's currently a thing. But as far as paying directly with Bitcoin to the grocery store, that might be a little of a surprise. So there's also companies like Robinhood, like PayPal, like Square, Venmo is a popular payment app where you can actually buy, sell digital assets and convert those digital assets into dollars that go straight into your bank account. So know that there's smart companies, there's technology companies, are payment providers, payment processors that are working on this problem to allow you to use your digital assets on everyday goods. There's something called the Lightning Network that is trying to integrate with traditional payment processors to allow these quick, cheap transactions and plug it into mainstream.
You said that one of the original uses for digital assets and the reason that they come about was decentralization, which we've talked about. So before we get into the downsides, let's talk a little bit about transparency and where does blockchain fit into that? Yeah,
so I think like blockchain is this confusing, dirty word, not dirty, but just a confusing word, blockchain. Like what is a blockchain? And basically, in simple terms, a blockchain is basically a public ledger. So like when you go to your bank account, you see the columns, there's debits and credits. That's a ledger, okay? That's all a blockchain is, except it's much bigger. It's a huge spreadsheet of debits and credits and transactions that are recording information that is impossible to alter, okay? It's impossible to change, it's impossible to hack, it's impossible to cheat a system. A blockchain is essentially a digital ledger of transactions that is distributed across an entire network of computer systems, right? So if I send you Bitcoin or Ethereum, I could go search that transaction and find it on the block, okay? and it would have a transaction ID, it would have a timing, it would have the amount sent, it would have my wallet address, your wallet address. It would show everything. Once that block is complete in the blockchain, that data is stored forever. No one could change it. It's verified as a legit transaction by the network. And it really is a beautiful thing.
Do you think there is pushback on digital assets because of the transparency, that there are people who do not want their business out and about?
I mean, okay, one, there's millions and maybe even billions of transactions happening every day. So it's not like your name and social security numbers posted on the blockchain. It's a hodgepodge of like 25 numbers, let's say, that reflect your wallet address. Okay, so it's not like
first and last name posted.
Yeah, it's not as, it's transparent, but in like an encrypted way, if that makes sense.
Sure, but someone somewhere could likely figure out what your wallet ID is, and then we would know who's sending Mr. Senator what money for.
Sure.
Who knows what. So there's some pushback because of that. Okay, well, I think that's great. How about the downsides? Because I feel like we hear about that more often than the upsides. So you mentioned scamming, the complexity of it.
Yeah, look, I've been, so for full disclosure, and I could share my personal journey into digital assets too, but you know, I think of myself as a curious and well-read person. I'm a professional investor by day. You know, I've been doing this for a long time. Digital assets are extremely complex. They're very high barriers to entry. Like, you have to immerse yourself in this ecosystem if you want to buy, store, and operate in the right way, so you're not exposing yourself to scam or sending money to the wrong chain or the wrong address. It's just very technical. And I think probably the biggest headwind is if these digital asset projects and protocols want to truly change traditional finance for the better and open this ecosystem up to the masses, they're going to have to figure out a way to make it simple, because it's not simple. It's extremely confusing. Okay, so I think
what you said there, I think what you said there is key about, I think the barrier to entry is actually quite low in terms of owning digital assets, but to do it right is what is difficult.
Yeah, so if you want to, so I think that's correct to a degree. Like, if you wanted to own Bitcoin or Ethereum, it'd be pretty easy to open a Coinbase account, which is one of the most popular exchanges. It's a centralized exchange, and buy that. But if you wanted to buy different coins or store your private keys offline in a cold wallet, which is the most secure way to, that's where it gets technical. That's where it can get confusing. So I agree with you. It's easy to buy those assets. To do it correctly is much more difficult. And I think that's where the barrier to entry is higher than most people would like.
So tell me a little bit about the off-ramp.
Okay, first, let's keep talking about the drawbacks, and not having enough off-ramps is one of them. Okay, so the second ugly thing in crypto is the scamming, is the phishing emails, is the hacking of wallets, is the hacking of exchanges. I mean, these scammers are not only looking at various protocol and project codes trying to hack into them, they're trying to find out who is using and owning digital assets and trying to get into their wallet, trying to get into their email to get access to those assets. So it really is the Wild West, which is another thing that needs to change, because a lot of people view digital assets as risky on an investment level, which is very true. There's another layer of risk with scamming and not doing it the right way and being duped. And I think that's another barrier for people that might be curious, but are scared of getting duped or ripped off. And then, regarding your off-ramp question, so this digital asset ecosystem is growing by the day. It's getting bigger and bigger. More projects, more tokens are coming online, and there's not enough off-ramps. And by off-ramps, I mean being able to convert a token. So let's say you invested in a new protocol, a new token project, right? And you're buying this token. It's not like you can readily convert that token into fiat currency, into paper currency, right? It's not easily done. There's not enough off-ramps in crypto. Like, if the stuff hit the fan, or if you needed money out quickly, nothing happens quickly when you're trying to get money out of your more enterprising digital asset projects. So I'm not talking about Bitcoin, not talking about Ethereum. Those are relatively easy to convert into paper currency. I'm talking about your smaller projects, your less known projects, which again, if you recall my earlier comment, Bitcoin is just shy of $1 trillion market cap. That leaves another, call it 1 trillion in other projects. It's really hard to get those other projects into paper currency. I feel like they're making progress, but it's not fast enough. And, there's liquidity issues, there's bridging issues, and I don't want to get too technical here, but there's issues in various steps to go from small token to your bank account. That needs to change.
Yeah, I think it's all really important for people to know this kind of stuff. Do you want to talk about Peer's offering?
Yeah. So I've been, first I'll share quickly my personal journey in crypto so people know where I'm coming from here. I'm not a crypto bro. I wasn't an early adopter to Bitcoin. I was curious. I was open to new ideas. And I really started to immerse myself in the space probably back in 2016. And I've always said that the best way to learn about an asset class is to own that asset. So I bought a little bit of Bitcoin, a little bit of Ethereum, I think a little bit later because Ethereum is newer. So Bitcoin was launched in 2009, Ethereum in 2015, I believe. And I just watched it. I didn't have an opinion. It wasn't life-changing money. It was money that I was fully open to losing. But again, a good way to learn about an asset is to own it. So fast forward, nothing, my Bitcoin went up, but again, it wasn't a substantial amount of money. So I didn't really do anything with it. And then I started to pay attention to the talent flow, right? And I started to notice on my Twitter that really smart people that might have gotten into big tech or went to go work in finance or went to go work in medicine were starting to work in digital assets. And some of these influencers and authors that I really respected and followed started to talk about it. And that's where I really started to deep dive. And then externally, there was all these events that I could slowly start to see the use case of digital assets converge with, and some of these things I talked about, where, the Canadian government shut down bank accounts. Innocent Russians are shut out of their bank accounts. You have sovereign nations, central banks running monetary and fiscal policy experiments. You're seeing decade highs in inflation. You're seeing social unrest. You're seeing all these things, and this is on top of our issues with big banks and bad corporate actors. So I think all of these things are not good for society to keep burying our heads in the sand and operating under the status quo. There's smart people doing something about it. And I think that's the allure, that's the appeal, and that's the tailwind to digital assets. Is not being governed by a central entity, not putting your financial fate in the hands of bureaucrats and corrupt dictators and poor acting corporations. It's just it's really a gambit. And again, I'm not saying that the traditional finance realm or playbook is finished. I just think digital assets could be a complement for the right type of investor.
So what type of investor is this right for, and who is it not right for?
Yeah, so I think if you understand technology, if you understand some of the narratives that I'm talking about on this podcast, if you can embrace risk, if you have the resources to put some money to work that you're prepared to lose, if you understand that your money could go to zero, that a normal day in crypto might be a loss or gain of 100%, it might be worthwhile to explore, okay? For those that don't understand it, that maybe are living on a fixed budget, that aren't comfortable with the space, that are not open to new ideas, that are conservative, that are risk averse, it's not worth it.
What about for the young person? Maybe they've just started out in their career, they've got some extra money on the side, but they haven't started investing in, say, their company's 401k. Oftentimes we're seeing there's a lot of young people who own Bitcoin, but they've never invested in a traditional retirement account.
Yeah, I don't think that's the best play. I think you should be on decent financial footing, meaning you're starting to allocate resources, money to these traditional metrics first, right? So there's tax advantages, one, for putting money in a 401k or an IRA. Historically, owning real estate has been a pretty good investment, although I don't think of my house as an investment. A lot of people do. So before dabbling with capital, I certainly would start to make progress on traditional savings, traditional retirement planning, and owning a house. I'm not saying that you have to own a house as a precursor to owning Bitcoin or digital assets, but know that I think of digital assets as a risky capital budget. I'm not really banking on that for anything. And if you need the money, if you're saving for a house, or you're going to retire in 10 years and you're looking to maximize your savings rate, I'm not saying throw a meaningful slice into digital assets. So it's a balance. You need to find out what works for you. It depends on other factors as well, like how risky your employment income is, what other income streams that you have coming in. Are you a single earner? Are you a double income household? Do you have kids? What are your monthly expenses like? So it's not a black and white answer. I think you'll know if you're ready, if you have discretionary income coming in and you fit the risk profile that I outlined before. I think you'll know when you're ready.
Okay, so your personal journey and experience with digital assets has now led you to a partnership with Arbor. Can you tell us a little bit about how Pure Portfolio is going to be able to offer digital assets to their clients?
Yeah, so this is coming. We've already signed the agreement, so the partnership is set. I've invested some of my personal money into the strategy, but Pure Portfolios I interviewed probably 10 digital asset offerings firms, and I landed on Arbor Digital. So Arbor Digital allows Pure Portfolios clients a secure way to access digital assets. So we basically take all the confusion, all the security issues out of your hands, and we're doing this the right way. And you're actually owning the underlying token, which I think is important, because there's other ways to get exposure to digital assets, like through a public trust. It's kind of like an ETF, but not quite. But the problem with those is there's massive tracking error. And what tracking error is let's say I'm trying to buy Bitcoin through one of these trusts, and Grayscale is the biggest digital asset trust company out there. What happens is the underlying trust price in Bitcoin, the underlying asset, can converge. That's tracking error. So let's say I buy this Grayscale trust, okay, and I'm down 20% in that trust. Meanwhile, the price of Bitcoin is up 30%, right? That's a bad outcome, right? Because you're already taking risk in a risky asset class like Bitcoin, and you want to enjoy what Bitcoin actually does, for better or worse, right? I guess it wouldn't be the worst thing if Bitcoin was down by 30% and this Grayscale trust was up by 30, but that's not how it works in practice. So Bitcoin up 30%, Grayscale trust down by 20%. That's a horrible outcome. I do not want to expose clients to that extra tracking risk. Mm-hmm. So what we've done is we've set up this partnership with Arbor. We take fiat currency, so dollars. We send it over to Arbor. They are the separately managed account manager. So they're buying and selling, they're doing the research, they have their own strategies. But the key is they're buying the underlying tokens. They're actually buying Bitcoin. They're actually buying Ethereum. They're actually buying Avalanche and Polygon and all these other blockchains. And that is huge. And so once they buy it on a reputable exchange, Gemini is the exchange. They're one of the largest institutional custodians for digital assets out there. Once they buy the digital assets on the exchange, they hold your private keys, which are basically keys to your crypto wallet, offline in a cold storage wallet. A cold storage wallet is like a two-factor authentication system. But instead of authenticating online, you have to physically authenticate. So no one could move your money. No one could move your digital assets without initiating the transaction online and verifying it with it's like a little fob that you hold in your hand by clicking a few buttons. So unless someone has that fob, there's no way in hell that they can get your funds.
It's pretty cool.
It's the cleanest and best way to store and own digital assets.
So is this something that, well, no, So we've talked about who this is good for and who it may not be the right fit for.
Here.
What else do clients need to know?
Yeah. So this is not a, hey, we're shoving this down your throat client, right? So this is a opt-in only. So in order to partake in the Pure Portfolio's digital asset partnership with Arbor, you have to sign a disclosure. You have to opt into this. And we're not talking about a large position size here. I mean, this might be 1 to 3, maybe max 5% of your investable assets that could potentially go into this. And it's up to your Pure Portfolio's advisor on who we bring this to. So part of our job is getting to know our clients. I mean, we've been working with many of them for a long time. We know their investment personality. We've framed their acceptable range of investment outcomes, right? So we understand what they're looking to do. We understand their investment personality. We're not going to bring this to someone who 100% invested in bonds, that is living off of fixed income, that is scared of their own shadow. Okay. So there's multiple layers to this. First, the Pure Portfolio's advisor screen on who he or she might think is appropriate for digital assets. Coming to a client, educating them. So we're hosting a webinar here in the next month, and I'll announce it when it comes out. And it'll be our full educational pitch on why we think this is important, why clients should be paying attention, the pros and cons, the risks, all that. From there, if a client feels like it's appropriate for them, they would sign a disclosure, which would have all the potential outcomes, good and bad, on it. Then we would place the assets with Arbor. So it's a very intentional, due diligence heavy process. We're not just winging it. We're not just throwing people into this. And that's to protect clients, and it's to protect the firm and Arbor as well.
So do you see this as a long-term play, or is this just a short-term cash grab, or is it what you make it?
I mean, it's what you make it. I mean, there's people that do both, and I don't think the two are mutually exclusive. But for the scope of what we're talking about here, for the folks that believe in the digital asset narrative, believe in the modern wealth playbook, they believe in Bitcoin, they believe in Ethereum, they believe in this decentralized new financial system, it's a long-term play. Okay. Now that doesn't mean the assets aren't liquid. Like, let's say a client placed assets in Arbor and the assets shot up by 300%. I'm just throwing this out there. That doesn't preclude them from taking the funds out and taking some profits. And know that within Arbor, there's two strategies. One is kind of I use this term very loosely, your blue chip digital asset strategy, which is Bitcoin and Ethereum, right? They're kind of the OGs, the original digital assets. Bitcoin, again, has been around since 2009, Ethereum since 2015. And then there's a more enterprising, more thematic strategy, which owns like 30 tokens or 25 tokens that is more of a emerging or risky strategy. So different blockchains, different protocols, different utilities, which is the strategy that I personally invested in. But we would help sort out which strategy might be appropriate for you.
Totally. Okay. We've covered a lot today. Any last recalls or things that we haven't covered?
No, I just want to share one more use case, and I know we're going long on time, but what's really exciting about this, there's a term called the tokenization of an asset. So I'll use an example. So let's say you are an investor and you want to get exposure to commercial real estate, right? And you might even have a project that's just down the street from you that's in a great neighborhood. There's an emerging business in town, and you see this as a really good investment. If this was 2005 or 1995 or even 2016, you would have to be a high net worth investor, an institutional investor, a private equity fund, a venture capital fund. You would have to have access to a huge pool of capital to participate in a deal like that. Okay. Digital assets, the tokenization of assets is looking to change all that. So what if we could tokenize that building? So same building. And what tokenization means is, instead of one building, let's cut that building up into 1 million different pieces. Okay. And if you owned one token of that building, you would have a 1 out of $1 million or 1 out of 1 million share in that project. So it really reduces the barriers to entry. It allows smaller retail investors to participate in projects that would normally be reserved for whale type investors. And this is actually happening, and this is very exciting. And this is kind of one use case of digital assets that might not be mainstream knowledge, but this is what's possible. And stocks are basically a tokenization of a company. So it's the same principle, but you're tokenizing real world assets. It could be a piece of art. It could be an antique car. It could be an office building. It could be a privately held company. It could be a blockchain. It could be a centralized exchange, a decentralized exchange. So that's what's possible. That's what's exciting. And when you talk about equality or inequality, I think digital assets have the potential to level the playing field, but that's a different conversation.
Maybe the next podcast topic.
I have one more thing to say, and this might seem egregious, but I really do believe it. If your advisor is not thinking or talking about or exploring digital assets, like if their only opinion is it's a fraud, it's a Ponzi, like don't pay any attention to that. In my opinion, not Pure Portfolio's opinion, Nik Schuurmans' opinion, that's a breach of their fiduciary duty. Like, this is coming. You can argue it's already here. You know, when people talk about it like it's some emerging technology that, you know, is still in its infancy stages. I think part of that is true, but it's also almost a $2 trillion market cap. Like, you can't ignore that.
Yeah, that's a great point. So you are very passionate about this topic. Thank you for sharing your wealth of knowledge. There's a lot to learn. It's a complex topic, but I think it's great as an introduction to new investors and old investors. So thanks for listening. If you have questions, send them over to insight@pureportfolios.com. And we're excited to chat with you. See you in our next episode.